In this lecture, we will explore exchange rates, parity conditions, and the way global financial prices fit together. An exchange rate is the price of one currency in terms of another. That sounds simple, but this price connects entire economies. It influences the home currency value of foreign revenues, imported costs, overseas assets, foreign debt, and international investment opportunities. Throughout the lecture, we will use a home currency per foreign currency quotation convention. Under this convention, when the exchange rate rises, the foreign currency becomes more expensive and the home currency weakens. When the exchange rate falls, the foreign currency becomes less expensive and the home currency strengthens. Before interpreting any currency movement, always pause and identify the quotation convention. Ask which currency is being priced, which currency is used as the unit of payment, and whose perspective you are taking. This discipline matters because firms rarely operate in only one currency. A company may sell abroad, buy foreign inputs, borrow internationally, or compete with foreign producers. Even a domestic firm can be exposed to its customers, suppliers, and competitors. Our goal is not to predict currencies perfectly. It is to understand how currency prices affect decisions, risk, and value. Exchange rates can be quoted in two reciprocal ways, directly and indirectly. A direct quote states the amount of home currency needed to obtain one unit of foreign currency. An indirect quote turns that perspective around and states how much foreign currency one unit of home currency can buy. Both quotations contain the same economic information, but they move in opposite directions. This is one of the most common sources of confusion in international finance. A rising direct quote may represent a weakening home currency, while the corresponding indirect quote is falling. Never describe a currency as stronger or weaker without naming the other currency and checking the quotation. Now consider appreciation and depreciation. A currency appreciates when its value rises relative to another currency. It depreciates when its value falls. Under our quotation convention, a rise in the exchange rate means the foreign currency appreciates and the home currency depreciates. A decline means the opposite. The business effect depends on the direction of the cash flow. A firm expecting to receive foreign currency generally benefits when that currency strengthens. A firm expecting to make a foreign currency payment faces a higher home currency cost when that currency strengthens. The central lesson is simple. Always connect the currency movement to a specific quotation, perspective, and cash flow. Exchange rate movements reach a firm through several connected channels. First, they affect revenue. Foreign sales may be stable in the customer's currency while changing significantly when translated into the firm's home currency. Second, they affect costs. Imported materials, foreign labor, shipping, overhead, and debt payments can become more or less expensive as currencies move. Third, they affect margins. Prices are often slow to adjust because of contracts, competition, or customer resistance. When exchange rates move before prices can change, profit margins absorb the pressure. Fourth, currencies influence competitiveness. A weaker home currency can support exporters by making their products less expensive to foreign buyers. A stronger home currency can make imported products more attractive in the domestic market. It is also useful to distinguish three forms of exposure. Transaction exposure comes from identifiable foreign currency receivables, payables, or financing payments. Translation exposure arises when foreign financial statements are converted into the reporting currency. Economic exposure is broader and reflects long-term effects on demand, costs, pricing power, and competitive position. Finally, exchange rates affect investment and financing choices. A foreign project creates value through the home currency cash flows ultimately available to investors. Foreign currency borrowing may appear inexpensive, but its true cost depends on both interest and currency movements. The manager's task is to map these exposures before deciding how to respond. Let's now separate spot rates, forward rates, and cross rates. The spot exchange rate is the market's current price for exchanging two currencies. Settlement may occur shortly after the trade, but economically, the spot rate represents an exchange arranged at today's market price. A forward exchange rate is agreed upon today for a currency transaction that will occur on a specified future date. A forward contract can lock in the home currency value of a known foreign currency receipt or payment. This replaces an uncertain future conversion rate with a predetermined one. Under our quotation convention, a foreign currency trades at a forward premium when it is more expensive in the forward market than in the spot market. It trades at a forward discount when it is less expensive forward. When forward contracts have different maturities, premiums and discounts are commonly annualized so that they can be compared consistently. These terms describe relative market prices. They do not, by themselves, tell us whether a currency is attractive or whether it will actually strengthen. Cross rates connect two currencies through a shared third currency. They are useful when a direct market quote is unavailable, and they provide a consistency check across markets. If quoted rates imply conflicting cross rates, traders may buy the relatively underpriced currency and sell the relatively overpriced currency. That arbitrage pressure tends to bring prices back into alignment. Spot, forward, and cross rates therefore form a connected pricing system. Purchasing power parity, usually called PPP, connects exchange rates with price levels and inflation across countries. Its basic intuition comes from the law of one price. When an identical tradable product has very different currency-adjusted prices in two markets, buyers are drawn toward the cheaper market and sellers toward the more expensive one. Over time, this buying and selling pressure can move product prices and exchange rates toward closer alignment. Absolute purchasing power parity focuses on comparable price levels across countries. Relative purchasing power parity focuses on how inflation differences are associated with exchange rate changes. The relationship shown on the screen captures this idea. When home country inflation is persistently higher than foreign inflation, the home currency tends to face depreciation pressure. When home inflation is lower, the home currency tends to face appreciation pressure. PPP is most useful as a long-run benchmark, not as a precise short-run forecast. Real markets contain transportation costs, tariffs, taxes, non-traded goods, product differentiation, and firms with pricing power. Prices can also be sticky. Capital flows, changing risk premiums, and investor expectations may dominate goods market forces for extended periods. A currency may even move before inflation changes because markets anticipate future policy or economic conditions. For managers, PPP offers a disciplined question. Are our exchange rate assumptions consistent with our inflation assumptions? It guides analysis, but it does not guarantee the next currency movement. Nominal exchange rates tell us how currencies trade. Real exchange rates go one step further by adjusting for differences in price levels. This distinction is essential for understanding competitiveness. A nominal depreciation may appear to make a country's products cheaper abroad. But if domestic wages, materials, and other prices rise at the same time, much of that apparent advantage can disappear. Likewise, a modest currency movement may have a large competitive effect when relative prices move in the same direction. The real exchange rate therefore asks a practical question. After considering both currency conversion and inflation, have home-produced goods become relatively cheaper or more expensive? For financial managers, this perspective is often more useful than the nominal rate alone. It supports decisions about pricing, sourcing, plant location, supply chains, and long-term market entry. PPP also helps organize several planning activities. In long-range planning, it gives a starting point for currency assumptions when inflation differs across countries. In international budgeting, it encourages revenue, cost, and exchange rate forecasts to be internally consistent. In pricing, it highlights the need to reconsider local prices when inflation differences persist. PPP is also valuable in performance evaluation. A foreign subsidiary may perform well operationally while reporting weaker results after currency translation. In capital budgeting, projected foreign cash flows, exchange rates, inflation, and discount rates should tell one coherent economic story. The objective is consistency, not false precision. Interest rate parity, or IRP, links spot exchange rates, forward exchange rates, and interest rates across countries. The central idea is a no arbitrage comparison between two hedged investment strategies. An investor can place funds in a home currency risk-free asset. Alternatively, the investor can convert into foreign currency, invest at the foreign risk-free rate, and lock in the future conversion back into home currency with a forward contract. Once the currency risk is removed, the two strategies should not offer persistently different returns after comparable costs. If they did, investors could shift funds toward the more attractive strategy. Their trading would then push spot prices, forward prices, or interest rates back toward alignment. The covered interest parity relationship shown on the screen formalizes this connection. In practical terms, interest rate differences are normally reflected in forward premiums or discounts. This means a higher foreign interest rate does not automatically create a superior hedged investment. The apparent interest advantage may be offset by the forward exchange rate. The same logic applies to borrowing. A lower stated interest rate in another currency is not necessarily a lower all-in hedged financing cost. For a valid comparison, maturities must match, and the assets should have similar credit and liquidity characteristics. Transaction costs and other market frictions also matter. For managers, covered IRP is best understood as a pricing benchmark for hedged international investing, borrowing, and currency risk management. Covered and uncovered interest parity sound similar, but they describe very different decisions. Covered interest parity uses a forward contract. Because the future exchange rate is locked in, the comparison is between hedged returns. This is why covered parity is primarily a no arbitrage pricing condition. Uncovered interest parity leaves the future currency conversion uncertain. It relates interest rate differences to the expected change in the future spot rate. Its intuition is that a currency offering a higher interest rate should be expected to depreciate enough to offset that advantage. But expectation is not certainty. Actual exchange rates can be driven by risk premiums, central bank policy, political events, capital flows, growth expectations, and investor sentiment. High interest rate currencies may strengthen rather than weaken, especially over shorter horizons. An uncovered position, therefore, carries meaningful currency risk. This distinction also helps us interpret forward rates. A forward rate is not simply the market's forecast of the future spot rate. It is a tradable price shaped by the current spot rate, interest rate differences, liquidity, risk, and demand for hedging. When a firm uses a forward contract, it is choosing certainty, not announcing a prediction. An exporter may lock in the home currency value of a foreign receivable. If the foreign currency later strengthens, the firm gives up that upside, yet the hedge may still have been sound because it protected planning, liquidity, and risk limits. Hedging should be judged by its objective, not by hindsight. Parity conditions are powerful because they organize financial thinking, but they are benchmarks rather than perfect forecasting laws. Purchasing power parity connects exchange rates with inflation and is most useful for long-run consistency. Covered interest parity connects spot rates, forward rates, and interest rates, and is most useful for evaluating hedged strategies. Uncovered interest parity connects interest rate differences with expected currency changes, and is most useful for understanding the risk in unhedged positions. Realized exchange rates can depart from these benchmarks because the world is not frictionless. Goods may not move freely across borders. Prices may adjust slowly. Taxes, transaction costs, capital controls, liquidity needs, and credit risk can interfere with price alignment. Investors may also require compensation for bearing currency risk. Exchange rates respond to many forces at once: expected growth, trade balances, fiscal policy, monetary policy credibility, political risk, safe haven demand, commodity prices, capital flows, and investor risk appetite can all matter. Notice the emphasis on expectations. Currency markets can move sharply even when current data remain unchanged, because participants are constantly revising beliefs about the future. For managers, the key benefit of parity conditions is analytical discipline. A forecast should not combine inflation, interest rates, currency direction, and risk assumptions that contradict one another without explanation. Good analysis asks two questions. Do the assumptions fit together? And what could cause the outcome to differ from the benchmark? Let's close with a practical framework for managing exchange rate decisions. First, specify the currency of every important cash flow. Revenue, costs, taxes, working capital, financing payments, and terminal value may each be exposed differently. Second, separate operating performance from currency effects. A foreign business can improve sales and margins in local currency while reporting weaker home currency results after translation. Third, make assumptions internally consistent. Inflation, interest rates, discount rates, and exchange rate forecasts should support one another. PPP and IRP are useful checks, even when they are not exact forecasts. Fourth, match the risk management tool to the exposure. A forward contract may suit a known receivable or payable. Longer-term economic exposure may require pricing changes, local sourcing, production flexibility, or a financing policy aligned with operating cash flows. Fifth, do not confuse hedging with forecasting. A hedge can add value by reducing uncertainty even when no one knows the next market move. Finally, focus on economic value, not only reported earnings. Currency changes can affect cash flow, debt capacity, covenant compliance, investment flexibility, and competitive position. The strongest policy is a repeatable process. Identify exposures, estimate their potential effects, define acceptable risk limits, and choose financial or operational responses deliberately. Thank you for joining me today. I'll see you in the next video.